So here's how we built an on-chain revenue-generating flywheel free from adversarial sell pressure and a clear utility growth curve. Let's jump in. So when we started building ACES, we already came to the table with some real battle scars. We've been in crypto since 2017, survived multiple market cycles, and launched a project in 2021 that hit a $1.5 billion market cap. So we knew the game well, but what we realized, what worked then doesn't work now. The playbook we used before, where you raise capital, implement vesting schedules, manage token burns, that worked for a specific moment in the market history, but that market has evolved. Buyer behavior has shifted dramatically, and token models that see today look vastly different to what they did before. Look around, we have hundreds, if not thousands of tokens launching every single day. We've got Solana, up and coming base ecosystem, you've got Monad, new tokens are being minted every single day, and you've got launch platforms like Pump, Bonk, Zora, Banker, absolutely saturating the market. So we chose to innovate. Our goal was clear. We wanted to serve our community with something familiar, yet technically innovative, to build something with genuine, long-term value that could survive multiple market cycles and stay culturally relevant for years to come. That way we could avoid the inevitable market downturns that would crash multiple projects time and time again, so we could, no matter what happens, stay relatively consistent in our project's positioning in the market. So I want to share everything that we did to hit a multi-million-dollar market cap token within hours. We ran zero marketing, did a fair launch model, and we now have a consistent and thriving community that grows every single day. And this isn't to brag, I just want you to understand exactly how we built this system and why it works. And here's the best part. The way that ACES works is a model that builds value over time. It actually compounds. The mechanics we're about to break down aren't just theory, they're live, they're working, and they're building real momentum every single day. So let's jump in. Step one, if you've been paying attention to this market cycle, you already know what I'm about to say. Fair launch models are dominating right now. Now we hypothesized that's for two reasons. Launch platforms like Pump Fund have made validation incredibly simple. Creators can take an idea to market, test it on a bonding curve, and let the community decide if it has legs. Secondly, the market is exhausted from vesting schedule dumps. People are tired of being exit liquidity for VCs who offload their bags during the initial hype. This basically created a model where it was extremely extractive and people would always lose, except for those who are on the inside. By using the bonding curve, we validated our idea, tested our community strength and resonance, and we built initial trust by proving that were no hidden parties waiting to dump. The era of aggressive investing schedules where VCs dump on retail hype, in our opinion, is over. The market is matured and people aren't really interested in funding venture capital exit liquidity anymore. Projects that try this approach fail fast and hard. And I don't need to mention specifics, but you know exactly who I'm talking about. With the right model identified and our reasoning locked in, we moved on to step two. And that was designing something for value accrual. Launching a token is one thing, but building it in a way that actually builds value over time, that's the real challenge. And this has always been a challenge in any traditional crypto project. It's actually validating why your token needs to exist, how it functions, and how it's going to actually grow over time. Now, value accrual in tokenomics is called utility. And projects with the strongest utility flywheel consistently perform the best. Why? Because there's a clear narrative that forms around the project, the community can build trust in the project, and market resonance grows. And there's tangible justification around the value growth of the token, not just hype or KOLs or any other kind of marketing stints. Given our deep understanding of the ACES scope and mission to tokenize art and bring it on-chain, we knew our token needed a core utility in the greater ecosystem. We aren't building a meme coin, we're actually pivoting to building infrastructure for a marketplace where real-world high-value assets can get tokenized and traded. So this opened us up to the core problem that most token projects face. As the platform grows, as more attention comes to the project, supply usually increases, which dilutes the value, which increases sell pressure, which we don't want to do. More users should equal more value, but inflationary tokenomics dilutes this value. So we ended up inverting this model. We flipped it on its head. Because we're building a marketplace and an exchange with high listing volume, we identified that a deflationary and derivative mechanism would best serve long-term value accrual. So here's how it works. Say a seller wants to list an item. This could be a car, a watch, art, a rare collectible, think Pokemon cards, trading decks, anything. In order to list their item, they must lock ACES, which removes ACES out of circulation. By removing ACES out of circulation, it creates a derivative pair. So they've got their item that's worth $100,000. They must lock that item, pairing it with ACES, and then creating a derivative market. So in this market, you now have derivative tokens that represent that underlying asset paired with ACES. This then creates a trading pool between ACES and the derivative token. This means tokens can never return back to circulation, and there is a new derivative token of this underlying asset representing its high value item that people can now trade. This means the market can trade exposure to a Ferrari, a Rolex, rare art piece without actually needing to own the underlying asset. So here's how ACES grows as the platform grows. Month one asset is listed. A little bit of circulating supply is reduced. Month 2, 3 assets are listed. The circulating supply starts to tip even further. By month 6, where we have 100 assets listed, the circulating supply starts to drop off a cliff as ACES becomes more scarce as more assets are listed onto the platform. The circulating supply starts to plummet. We get to month 12 with 500 assets listed. The circulating supply is starting to fall off a cliff and the pool starts to decrease. Each new listing multiplies the deflationary pressure. This creates a quadratic effect and the acceleration grows. So let's look at the demand side. Why do people even need ACES to trade? So one, a trader sees that this cause watch is starting a trend. It's on the base ecosystem, it's at the top of the leaderboards, and it's showing good, strong volume. They're like, wow, there's a lot of volume coming to this. I want to trade exposure to it. Let me go buy some. Before they can actually buy some, they actually need to purchase ACES. By them purchasing ACES to trade exposure to this derivative token, it removes ACES from circulating supply and increases the buy pressure on the ACES token. That means every single trade against a derivative token creates ACES buying pressure. Okay, now let's move on to cause 2. So every time ACES is traded against the derivative token, a 1% fee is charged. Again, this fee is charged in ACES, further reducing the circulating supply. Then this fee is actually awarded to the seller who listed that item in the first place, where they get 50% of all trading fees on their actual asset, which they can either use to cash out or they can hold ACES to list further items in the future, further reducing circulating supply, as each pairing removes ACES permanently from circulation, as it functions as a base pair for all derivative assets. And finally, cause 3, which you've already covered, is a seller wants to list a $500,000 watch. They must lock approximately 10,000 and up ACES, which permanently removes ACES from the supply, pairs it with that asset, creates the derivative token, permanently removing ACES from supply. Then this creates that flywheel effect where more people want to come in and trade exposure to that derivative RWA. Okay, let's look at the self-reinforcing flywheel effect that we've got going on now. So cycle 1, we've got asset growth. We've got traders, they see a derivative token that's trending, they want to trade it, volume goes up, the more volume equates to more fees, which equates to more money for the seller, which incentivizes them to bring more products onto the platform, as well as incentivizes the platform to reinvest into finding more products, building out the infrastructure, and ultimately attracting more high-value sellers that want to bring their products to the platform. This leads into the token value appreciation, where now we're attracting more sellers and more traders to the platform, where people are actually moving and selling products, people want to get involved into this. It's a whole new thing. They're like, cool, I can actually move my high value, generally stagnant assets and actually bring them over to the crypto market and start to move them. Now, the more of this that we have, more ACES leave in circulation, which is going to decrease the circulating supply and drive the demand. Now, between these two mechanisms, we have a lot of buy pressure on the ACES token, which is going to continually drive value back to the platform, back to the community, and ultimately incentivize more liquidity for these traditionally locked assets. Now, let's look at the economic logic. So traditional platforms, more users, we need to incentivize growth, so we issue more tokens, the token value dilutes, and early supporters are actually punished. Now let's look at the ACES model. The more assets we get from more sellers moving their products equals more tokens locked forever, which means less supply is available, which means either same or growing demand, and the token value is ultimately going to increase, which means the early supporters are rewarded, and the platform growth directly benefits all the token holders and the future sellers. So why would sellers be even incentivized to pay a fee to list their product on the ACES platform? Well, in the ACES reality, you lock 3,000 ACES to list a $100,000 watch. The platform growth makes your locked ACES appreciate. you earn 50% of the trading fees as people trade the derivative of your watch, and your 3,000 locked position can multiply when the watch actually sells because of all that demand pressure on the actual ACES token itself. So to summarize, you actually made money from the watch sale, the trading fees, as well as the token appreciation. This is the net effect of the listing requirement actually becomes an investment and not a cost. So in summary, the ACES tokenomic model is a self-reinforcing economic system where platform growth directly benefits token holders as well as incentivizes new sellers to bring their traditionally locked and illiquid assets to a liquid and thriving market. As more sellers come, we lose supply and we increase demand. Every new listing makes ACES even scarcer. Every trade creates buying pressure on ACES, and the more successful the platform, the stronger both of those effects actually become. So what we've got is a quadratic deflationary flywheel rather than an inflationary death spiral that most traditional platforms face. And we did all this with a fair launch, directly to market, no vesting schedules, open and ready for anyone to participate. So that's how we built ACES Tokenomics. If you have an asset you'd like to list, submit your contact details and we'll run it through our proprietary verification and we'll add it to the listing program. Next video, we'll run you through the trading dynamics on how traders can actually make money on the sale of the asset as well. I'm sure you'll love that one. See you next time.